It's Friday, 6th of June, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, rising defence spending. What does that mean for economies worldwide? But first, Neil Shearing, Group Chief Economist, joins me to rake over the coals of another week in macro and markets. Hi, Neil.
Hi, David.
Usual caveat, it's 2:30 London time, that's 9:30 DC time. Anything can happen in the coming hours. But what I'd like to do to start is avoid asking for your take on what happened between Donald Trump and Elon Musk. Focus instead on the other big issue, which is what else? Tariffs. We said in January that this idea of tariff front running would give a temporary boost to global trade. This idea that you get your orders in early before tariffs rise, before these levies kick in. That is indeed what happened. But now, over the past week, it does feel like there's been more and more signs that's coming to an end. So looking at the totality of all the data that's come out, does it suggest that we are moving into a new phase? And if we are, what are the implications of that?
I don't know if it's coming to an end. The way I would characterize it is that we had some pretty extreme distortions to global trade in March. As you say, firms tried to get ahead of the tariffs to front run them. And what that meant was that we saw this surge in imports into the US ahead of the tariffs. And the counterpart to that, obviously, was a surge in exports to the US from other economies. And then Liberation Day happens, April the 2nd, tariffs go up. And having just had the surge in imports in March, it all unwinds, or a large chunk of that unwinds in April. So over the past week, we've had the April trade data from the US. That showed a huge narrowing of the US trade deficit in April, having had this big expansion in March. So what we've really seen is this distortion caused by the front running of tariffs unwind in April. Now, the question you posed was, is that the end? And I think the answer is we can't really be sure that it is the end, because we're not sure really, are we, what the end game for tariffs might be. Obviously, since April, we've had the supposed truce and deal between the US and China to lower tariffs on one another. We'll get the China trade data for May over the coming days, and we'll see what impact that has on China's exports. We're expecting a relatively strong number compared to the consensus. So I don't think the effect of tariffs and the behavioural effect of tariffs has fully played through, because I don't think we're not yet in the tariff endgame.
Behavioural is key here, isn't it? Because yes, as you say, we've seen this unwinding in some of the data, but in certainly the survey-based data, what we're seeing is quite a negative impact stemming from the tariffs or the uncertainty around tariffs. Would you say then that's going to then translate into hard data? I mean, talk about what we've seen in terms of things like the Fed Beige Book, but also in the PMIs that we've had over the last few days.
The Fed Beige Book in particular was pretty grim reading. So this is a collection of reports by regional Fed officers. They go off and interview different companies. And it makes for pretty grim reading in terms of the impact of tariffs and the uncertainty that it's generating within the business community and the associated impact on the economy. But this is, at the moment, these are just essentially anecdotal reports. And if we look at the soft data, the survey data that we've had, so for example, the ISM, the surveys over the past week or so, they've been soft too, particularly the ISM Services Index. But the relationship between these surveys and GDP over the past few years has not been particularly strong. So some evidence that the economy is struggling a bit in the face of tariffs, but I don't think it's overwhelming. And of course, we're speaking just after the payrolls data, and that was reasonable. But really, I think the US labour market holding up for now. Where I think there is some clear evidence that tariffs might be having an impact is if you look at the price components and sub-indices of some of these surveys, they're pointing to an increase in inflation. And the relationship between these prices balances and inflation has been stronger than the relationship between the output balances and GDP. So not great news for the Fed, really. Its Beige Book is painting a pretty grim picture on activity. We'll wait to see if that translates through to the real economy. I think we'll have a period of weakness, but not necessarily a recession. But on the inflation front, signs that things are going in the wrong direction. So, as we've said for a while, the effect of tariffs, I think, mildly stagflationary, and we're starting to see that play through in the data.
I'd like to come on to monetary policy more globally, but before I do, just going back to that point, you're talking about this uncertainty. We're in a bit of a fog of uncertainty. at the moment, aren't we? And for all that we've talked about how it's weighing on sentiment at a firm and household level, this isn't really an environment, is it, for businesses to be moving ahead with investments? So, on the basis that businesses need some kind of clarity in order to go ahead with plans, where does that clarity come from? Talk about how long we're going to be living in this state of uncertainty.
Well, I think it's quite interesting here. If you go back to the textbooks and have a look at what Keynes was saying about uncertainty, and he distinguished between risk and uncertainty. And in his mind, risk is something you can quantify. You can say there's a 10% probability of something happening or a 90% probability of something happening, whereas uncertainty is something that is much more difficult to quantify. Indeed, in Keynes's view, was impossible to quantify. And when we're talking about Trump sitting on no longer Twitter, but Truth Social, and firing out, we don't call them tweets, truths or whatever we want to call them. That is the ultimate form, I think, of uncertainty. And that does incredibly difficult for businesses to navigate, I think, particularly businesses that are highly integrated into global supply chains and are making multi-billion-dollar decisions about capital investment over multi-year horizons. So, yeah, distinguish between risk, which is quantifiable, and uncertainty, which by definition is not. So important to distinguish between risk and uncertainty. And there's growing evidence, if you look at some of the surveys, that this uncertainty is starting to weigh on investment intentions, not just in the US, by the way, but in some countries particularly dependent upon exports to the US. Now, when's it going to clear up? Inherent within the idea of uncertainty is that nobody knows. This is unknowable. So I think it would be disingenuous to say, this time next month we'll have much greater clarity on the landscape, because I don't think we necessarily will. Now, there were some court cases pending. The judicial case that's been brought against the US government on tariffs will start to hit arguments in that, I think, over the next week or so. So we might start to get some clarity in those areas, but whether this fundamental kind of uncertainty over US policy lifts as a result, I'm less convinced about.
Okay, let's go back to this question of inflation and monetary policy, because we have had a couple of interesting decisions this past week. I want to talk about the Reserve Bank of India. They did a bigger than expected 50 basis point cut. And then Shilan Shah, the head of our India coverage, says that's basically the end of their easing cycle. And then the ECB, they cut yesterday. And our Europe team is saying that basically they're nearing the end of their easing cycle, maybe one more to go. So to what extent are these banks outliers? How close are we to seeing the end of the global easing cycle? And in that, I would include the Fed. I mean, how long are they going to stay on the sidelines for?
I think we're through the period now where we've seen the big cuts in interest rates. There's been quite a substantial reduction in interest rates across most major economies over the past 18 months or so. And I think the big cuts are in the rearview mirror now. So it was striking, I think, when you look at the ECB decision and the subsequent press conference over the past week, Christine Lagarde stressing several times that she thought the ECB were in a quote unquote good position. And then in the days that followed, several media leaks suggesting that a number of governing council members thought it would be appropriate to pause rate cuts at the next meeting in July. So I think it's pretty clear that the ECB feels like it's done a fair amount of easing. It's now in a good position, as Lagarde has said. Some members think, time for a pause. I think we're getting to the end of the rate cutting cycle in Europe. Maybe one more cut to come. We've got on our forecast for September, but then that might be it. India, you touched upon, I think that's partly about front loading of cuts there. We had a 50 basis point cut rather than the 25 basis point cut. But I think that, as you say, calls an end to the easing cycle there. That leaves the UK as a bit of an outlier. So I think the UK is one where there's perhaps a bit more work for the Bank of England to do. If you look at the extent to which the economy is weakening, obviously inflation's been slower to fall in the UK than has been the case in, say, the Eurozone. And so the Bank of England a bit further behind the ECB in terms of monetary loosening. So yeah, maybe some more rate cuts to come in the UK. We've got rates there falling to 3.5% by this time next year. We're currently at 4.25. So a bit more work for the MPC to do. And then, as you say, how does the Fed fit into this? The market is still pricing in, at the time we speak, 25 basis point cuts this year. I think that looks quite ambitious if you take into account that the economy so far doesn't seem to have been whacked too hard by tariffs and the threat of tariffs. That, as I said earlier, there are signs in the surveys that inflation pressures are starting to build a little as a result of tariffs. And in the general environment, I think the Fed has signaled that it's just going to stay on the sidelines and be in wait and see mode. We pour a little bit of cold water on the idea there's going to be rate cuts this year. So maybe those Fed rate cuts are going to come early next year instead, I think. Once the Fed has a bit more clarity about the effect of tariffs. Now, could be wrong, but I think for the Fed to cut this year, you need to have a substantially weaker US economy. And in the data so far, there's some softening, but there's not a collapse. And in our forecast, we don't expect a big collapse in growth in the US either.
Yeah, data does seem to be holding up. I started our chat by saying I wouldn't ask about Musk and Trump, but I do want to bring that up because, as far as I could tell, it all started, in public at least, with Musk calling this quote-unquote big, beautiful tax bill that's working its way through Congress a disgusting abomination. Is that fair? Is it a disgusting abomination?
It's pretty colourful language, isn't it? I'm not sure that would make it into a Capital Economics publication. But Trump has called it big and beautiful. I think that's half right. I think it's big. I'm not sure it's beautiful. And part of the absence of beauty is the fact that it's so big. Now, it depends a little bit on what you assume about tariff revenue. Of course, the bill does not include any tariff revenue because we get to see where tariffs land. If there's no tariff revenue, our estimates suggest that the bill that's currently working its way through Congress, if it's passed, will leave the budget deficit around 7% of GDP over the coming years. If you factor in some tariff revenue, that might come down to something like 6% of GDP. But either way, this is an enormous deficit, particularly given the fact that the US economy is running at full employment. This is very different from, say, 2010, when high rates of unemployment in the US meant that tax collection was much lower and outlays on things like Social Security and jobless claims were much higher. So the US economy is now at full employment. This is the time when you should be running small surpluses, ideally, and if not a surplus, then a very small deficit, not a deficit of 6% of GDP. And of course, the federal government debt burden in the US is already quite high. And to boot, real interest rates are no longer negative as they have been for much of the past decade or so. They're now positive. So it's a pretty ugly fiscal mix. I probably wouldn't use quite the same colourful language that Musk has used, but the former Treasury official in me thinks this is a bit of an abomination when it comes to fiscal policy. This is not what you would call responsible fiscal policy. Now, the question for the markets is, at what point does the bond market's patience snap? I don't think we're quite there yet, but if you look at the long end of the curve, clearly you see concerns over America's fiscal trajectory over the long term. Those aren't going to go away with this bill, that's for certain.
Presumably the Senate isn't going to water it down enough to change that trajectory.
It remains to be seen, but the noises coming out of Washington so far don't suggest that major revisions are on the cards, do they?
That was Neil Shearing on uncertainty around tariffs, the global easing cycle, and that one big, beautiful bill, or that disgusting abomination. Take your pick, depending on what side you're on. We discussed that RBI cut on India. Don't miss our drop-in. That's one of our short-form online briefings that's happening this coming Tuesday, 9 a.m. London, 2:30 Mumbai. It's all about the outlook for India's economy and financial markets, and the briefing will include why we are so non-consensus on the outlook for Indian equities after their recent run of outperformance. Details of that session can be found in the podcast notes. Now, NATO defense ministers have been meeting this past week ahead of a key summit at the end of the month that's intended to formalize a target to raise defense spending to 5% of GDP. If it does get agreed, it'll mark an extraordinary shift in the geopolitical mood and in transatlantic relations in the wake of Donald Trump's re-election. That 5% target would also represent a significant ramp-up in spending from current levels, as Vicky Redwood, our senior economic advisor, has made clear in recent reports on the macro implications of more military spending. I spoke to Vicky earlier Friday about all of this, and I started by asking how achievable the 5% target really is.
I think it's quite a tall order. Admittedly, there does seem to be a bit of wiggle room within these proposed targets. So of the 5% commitment, 3.5% will be to do with core defence spending, so your essential military equipment, and then 1.5% will be sort of rather woolly term of defence-related equipment. So that could be things like cybersecurity or defence-related infrastructure. So the plans are perhaps a bit less testing than they might first appear. But even if we consider that there's still a handful of countries that have not even met the 2%, current 2% NATO target, and then the vast majority of NATO members currently have defence spending as a share of GDP of about 2%. So this is a pretty tall order. Whether it will be achieved remains to be seen. But I think I would probably interpret it more as just a signal of the direction of travel. There's obviously momentum building towards increased defence spending, primarily in Europe, but not just in Europe, in other parts of the world too.
Name and shame. I mean, talking about Europe, which countries are best positioned to achieve these targets as they're being discussed, and which do you think are going to find it hardest to get there?
I think it probably comes down to two things. One is, do they have the incentive, the will to meet these targets? And the countries who are perhaps most incentivized are those that are closest to the threat, those that are just geographically closest to Russia, for example. Those whose economies perhaps have more to benefit from increased defence spending, so those with bigger defence sectors like Germany or France. And so then the countries that are perhaps most likely to meet them are those that have scope to borrow more, so that currently have relatively low levels of debt. To be honest, it's quite hard to find countries like that. Germany is the obvious example of a country that's got relatively low government debt and has indeed already planning to loosen its fiscal rules to fund higher defence spending. But most other European countries will find it much harder to do that. So I think we've already seen plans in Germany to boost defence spending quite significantly, but you'll probably find other countries that are more remote from the threat, where there's less will to increase defence spending, say Spain or Italy, will see less of an increase there.
That's key, isn't it? Because long before Trump was re-elected and we had this renewed pressure on Europe to raise defence spending, you had been researching extensively the fiscal strains on countries, looking at particularly at things like the impact of ageing population. Now you have this ramped up pressure from the White House. Does that just make the trade-offs that much worse, that these countries which don't have the fiscal resources already to spend on things like meeting these demographic challenges, now they have this extra pressure to meet these increased defense spending targets? Does that make the trade-offs that much worse in terms of guns versus butter?
Yeah, it certainly does. And it's interesting, if you look back at a few decades ago when defense spending was higher, that was largely paid for, in inverted commas, by lower levels of health spending that we've got now. Now health spending is higher, and it's only going to get higher from here because of the pressure of ageing populations, particularly in many European countries where perhaps the pressures to raise defence spending are also highest. So there's no sort of easy answer to this. Governments have got some difficult decisions ahead about how they're going to balance these trade-offs and what's going to give. And we're seeing that in the UK, obviously, in the current spending review round, that we want to spend more on health, they want to spend more on education, they want to spend more on defence, and then these other parts of government spending that are left are just getting ever more squeezed. And then it comes down to, all our governments willing to raise taxes instead to pay for these increasing priorities. Whether they're willing to do that obviously depends on different electoral pressures in different countries and whether the tax is already relatively high or not. And in countries like France, taxes as a share of GDP are already pretty high, but there's perhaps more scope to raise taxes in other countries like North America, where the tax burden's a bit lower.
On the surface, raising taxes would translate into slower economic growth. More defense spending, would that translate into higher economic growth? How do these two competing forces pan out?
It depends a lot on what sort of taxes you're raising, what sort of defense spending you're increasing, what sorts of other government spending you might be cutting to pay for it. It also depends on the structure of the economy. Does it produce a lot of the defense goods itself? Will it end up importing them? And so that sort of extra spending just leaks abroad. So there's a lot of factors to think about here. If we're just thinking perhaps about the short to medium term impact on the economy of increased defense spending, I think the main factors are, does the country produce a lot of defense goods itself, or will it have to import them? Even if it does produce defence goods itself? Does it have spare capacity within the defence sector, or indeed the wider industrial sector, if it could repurpose some of that towards defence to produce more? Because if not, this extra demand is just going to feed into higher inflation. And then also, how is it going to pay for this extra defence spending? Is it going to be through extra borrowing, which is a fiscal stimulus, but in a country with high borrowing and debt levels already might push up bond yields and interest rates that have a depressing effect on spending? Or is it going to fund this rise in defence spending by raising taxes or cutting other types of spending? If it's then cutting other types of spending that are relatively unproductive, like some parts of the welfare budget, that might not have a negative impact on growth, but it might be raising taxes that act as a disincentive to work, which will weigh on growth. So yeah, there's a lot of factors to think about when thinking about the net impact of all of this.
Okay, but take Germany then as an example, because here you have a country which does have developed defense industries. It does have the fiscal resources to increase defense spending, maybe not to the amount that's being discussed, but never mind. But it has loosened its fiscal brakes, and it obviously is very much at the heart of this discussion about this need for increased defense spending. So given all that you've said and all of these competing forces, how will that be reflected in Germany's economic outlook?
Yeah, well, Germany is one of the countries that will benefit more for sort of a given rise in defence spending. In the jargon, its fiscal multiplier on defence spending is probably higher than in most other European economies for those reasons you just talked about. So we think there will be a decent boost to German GDP over the next few years from this planned rise in defence spending. We think it could add about 0.4% to GDP per year. So that's certainly significant. And that will add about just over 1% to GDP over the 2 to 3 years that we expect that rise in spending to be spread over. Another factor to think about in all this is what then the longer term impact is on GDP. So you can think about just the sort of short run impact on demand, but will this rise in defence spending have a more longer lasting boost to an economy's supply potential? So spending on defence doesn't directly make an economy more productive, and it can divert resources away from areas which would have boosted productivity. So if the government might have been going to spend a lot on AI investment in the economy, but it's now going to use that money to spend on defence instead. So there's that opportunity cost to the economy's long-term potential. But generally speaking, I think if defence spending is done in the right way, it can have significant positive long-term effects for an economy. And that's partly because defence spending creates technologies that then can be used across the wider economy and have spillovers to other sectors. And also because a greater incentive of military procurement can then encourage private sector R&D. So there's this sort of two-way relationship. Government spending helps the private sector, but also then the private sector helps the government. And there is evidence that these long-run positive effects on productivity growth from defence spending can be quite significant, but it does depend on sort of certain conditions being in place. For example, that a reasonable proportion of an increase in defence spending goes on R&D rather than just employing more people in the army or buying more weapons. And also if the conditions to encourage productivity and innovation in the wider economy more generally are in place. And actually that is one area where Europe has tended to fall short, and is why it has a sort of generally lags on productivity relative to the US, for example. And so that might be a reason why perhaps the longer term positive effects of defence spending are not so large in Germany and Europe as they would be in, for example, the US.
But there is a world in which defence spending increases in Germany, R&D spend increases, and so these well-documented problems with German industry and German industry's ability to compete are to some extent overcome.
Yeah, I think this will help. But to have a revolutionary impact, you would need to have broader government reforms, not just related to defence, but sorting out some of the wider issues in the German economy and European economy. And if the government is willing to take that broader look and undertake structural reforms, then all well and good. But high defence spending on its own is not going to overcome those longer term problems.
Vicky Redwood there talking about the economic impact of a rise in defence spending. She has two notable reports out on this, one on the global story and one that's part of our Future of Europe series that talks specifically about the European experience. The Future of Europe series has been running for the past few weeks. There are now 12 in-depth reports along with interactive data dashboards that cover everything from Europe's relations with the US and China to the future of the euro, to monetary policy reform. Quick digression, Germany is a big part of that story, and I'm happy to say that our Europe team's just been named the most accurate forecaster in the market of the German economy. Excuse the brag, but it is just the latest addition to our awards haul. You can find out more information about that win and about all of the awards that we won for our forecast accuracy on our awards page. That's capitaleconomics.com/awards. And we'll have much more to say in the coming days and weeks about other awards that we have won this year. Anyway, back to Vicky's reports. I will add both of them to the podcast notes. Do check them out. They really put this whole debate into its proper macroeconomic context. Vicky also mentioned the UK spending review. That's the Chancellor's department-to-department effort to allocate limited fiscal resources. That spending review will be out on Wednesday, and soon after it, our UK team will be holding a drop-in to talk about how the UK's fiscal situation is shaping its economic outlook and the direction of gilt yields. I will add a link to that short briefing in the notes as well. Do join the UK team, get your questions in, and hear what they have to say. But that's it for this week. We will be back next week with much more from the front lines of global macro and markets. Until then, goodbye.